Here's a shocking reality. While the Trump administration has been championing fossil fuels with policies aimed at boosting oil and gas production, major U.S. energy companies are slashing jobs left and right. Yes, you read that right. Despite the push for expansion, thousands of workers are losing their livelihoods. But here's where it gets even more puzzling. These cuts are happening even as the industry has seen significant growth in recent years. So, what's really going on? Since the COVID-19 pandemic, the U.S. oil sector has entered the era of the mega-merger, with giants like Chevron, Exxon, ConocoPhillips, and Occidental snapping up smaller companies to expand their operations. For instance, ConocoPhillips acquired Marathon Oil in a $17 billion deal last year, significantly growing its workforce. Yet just months later, the company announced plans to cut up to 25% of its global staff. That's 3,250 jobs by the end of 2025. Dennis Nuss, a company spokesperson, framed it as a move toward efficiency, but the timing raises eyebrows. And this is the part most people miss. These layoffs aren't isolated incidents. Chevron, the nation's second-largest oil company, is set to cut up to 20% of its workforce by 2026, potentially affecting 9,000 employees. The Trump administration's policies, designed to accelerate oil and gas permitting and open federal lands for exploration, are expected to fuel further growth. But here's the catch. Many of these policies won't take effect for years. Meanwhile, oil prices, though rising slightly, remain far below their post-pandemic highs. The average U.S. crude price of $64 per barrel this year has allowed companies to keep drilling but hasn't delivered the profits they're used to. Take ConocoPhillips, for example, whose profits dropped 15% year-over-year to $2 billion in the second quarter. But here's where it gets controversial. Is the Trump administration's fossil fuel push truly benefiting American workers, or is it exacerbating the industry's volatility? Critics argue that while these policies may boost production, they don't address the underlying economic challenges facing oil companies. For instance, OPEC Plus's recent decision to increase production by 137,000 barrels per day starting in October could further depress global oil prices, squeezing U.S. producers even more. This move has already caused international oil prices to drop by 12% this year, pushing many U.S. companies closer to break-even. The ripple effects are clear. Halliburton and SLB, major oilfield service companies, have also announced workforce reductions. According to a Reuters analysis, 22 U.S. oil producers, excluding Exxon and Chevron, have cut their capital spending by $2 billion. Even in the Permian Basin, once a symbol of the drill baby drill mantra, companies are now adopting a wait baby wait approach, with many requiring oil prices between $70 and $75 per barrel to resume full operations. So, what does this mean for the future? As OPEC Plus ramps up production, low oil prices are likely here to stay, spelling continued low profits and cautious spending for U.S. companies. The mega-merger era, marked by high spending and expansion, seems to be giving way to a period of consolidation and cost-cutting. But the bigger question remains: can the U.S. oil industry sustain growth while shedding jobs? And what does this mean for workers and communities reliant on these positions? What do you think? Is the Trump administration's fossil fuel push a boon for the industry, or is it overlooking the human cost? Share your thoughts in the comments. This is a conversation worth having.